Hi, welcome to this Accofina tutorial. This is an accounting tutorial. We're back doing accounting after a couple of other areas, and today we're doing accounting for dividends. Specifically, we're going to look at common stock dividends, preferred stock dividends, and stock or share dividends. So let's get cracking. Alright, so what are we covering today? We're going to do a brief background into dividends. Then we're going to talk about the three important or relevant dates for dividends. Then we'll have an example where we go through the journal entries of declaring and paying a dividend. Then we'll have a background into preferred stock or preference shares as they're known in Australia. And then we'll have a few examples because there's a couple of variables that have to change. So we'll account for preferred stock dividends, do some calculations, and also some journal entries. And then finally, we'll look at stock or share dividends. We'll do this by giving a brief background again, then have one more example into the journal entries for stock dividends. Alright, here we go. Okay, brief background on dividends. Now, dividends are paid by the company to the stockholders. The stockholders are the owners of the company, and the company is paying them part of their profits. Receiving dividends is one of the basic rights of being a shareholder or a stockholder. As I just said, you're an owner and you're entitled to benefits. And it's how the company owners share in the profits of the business. Now, dividends are paid from the equity account, retained earnings. Or, more simply, they're paid from the profits or earnings of the company and they're returned to the shareholders. And here's a quick reminder of a quick calculation. This period's earnings minus dividends equals this period's transfer to retained earnings. So, each year, you build up a lot of earnings, you might pay some dividends, and whatever's left over is transferred to retained earnings in the equity accounts. Okay, now there are three important dates of dividends. The first is the declaration date. This is when the board declares a dividend, saying a dividend will be paid soon. This declaration creates a dividend liability. So perhaps in the real world, the board will meet on certain day or evening, they'll agree to a particular dividend amount and what day they're going to pay it. Then they'll put a notice out to the market, so it's public information, and that is the declaration date. From then on, there is a dividend liability. The second important date is the record date, or date of record as it's also known. This is the date that determines who will receive the dividend. In other words, those on the share registry on the record date will receive the dividend. So when the board declares a dividend, they'll also declare a record date or date of record. And then anyone who owns shares on that particular record date will receive the dividends. Now normally the record date is about 2 days after the ex-dividend date. And this accounts for the T+2 settlement period, which is common in many countries. And that would allow people to buy and sell prior to going ex-div, and then have a couple more days for the settlement to actually occur and you become the legal owners. And the third final date is the payment date. This is when the dividend is actually paid in cash, and this will discharge the dividend liability. Alright, so here's our first example. Now on the 1st of October, the board of Fablet Limited declared a dividend of $1 per share. The dividend is payable on the 20th of October for stockholders on the 12th of October date of record. And there's a note there saying there are 75,000 shares of common stock outstanding. And with the magic of television, let's get to our example. Okay, so here's example 1. So we're just in Excel here. I've pre-prepared it, but I'll go through it with you. So we have some key facts from that example. On the 1st of October, the board declared a $1 per share dividend. The 12th of October is the date of record. The 20th of October is the payment date. And there's 75,000 common stock outstanding, or common shares outstanding, or ordinary shares outstanding. Oh, to be honest, common stock, ordinary shares, yeah, depending where you live, they're all meaning the same thing, but yeah, they're named depending on your jurisdiction. Okay, so here's our journal entries. This is the 1st of October. So this is the declaration date. Now we would debit retained earnings. So we would draw from retained earnings, as we said earlier, that dividends come from retained earnings, and we would credit dividends payable. So we're creating a liability for the dividends, and we are drawing from retained earnings. And the reason it's $75,000 is there's 75,000 shares, $1 per share. On the 12th of October, that's the record date, there is no accounting effect. Nothing happens. It's just an administrative matter about who gets the dividends and who doesn't. And then when we pay the dividend on the 20th of October, we would clear out that liability. So this time we debit the liability, debit dividends payable, and we would credit cash at bank. Now we're paying our cash to clear the dividend liability. And that's all there is. It's pretty simple when you think about it, and happy to answer any questions if I'm not clear enough, so just feel free to comment. But I hope it's okay. Alright, let's get back to our slideshow. Okay, so that was our first example. Okay, we're going to talk about preferred stock or preference shares. Okay, that's another name quirk. You might know them as preferred stock. In Australia, I know them as preference shares. And what makes a preferred stock a preferred stock? Ultimately, it's that they have a fixed dividend. Preferred stockholders are paid a predetermined fixed rate or amount of dividends. So you might buy a preferred stock and it may entitle you to a certain dollar amount of dividends per year, or perhaps a certain percentage of the price or so forth. Secondly, they're paid dividends before the common stockholders. This is, I think, where the name preferred or preference comes from, is that their dividends are preferred or preferenced over the common stockholders. It's one of the key characteristics. Preference shareholders must be paid their dividends before any common stockholders can get a hold of their dividends. Now, preference shares can be cumulative or non-cumulative. I'll try to say that clearly. Preference shares can be cumulative or non-cumulative. Okay, I hope you can read it if I can't speak very well. Okay, cumulative means any unpaid preference dividends accumulate and must be paid before the common stock dividends. Non-cumulative means any right to unpaid dividends are lost. They do not accumulate. So for instance, if we have a company that has a bad year and doesn't want to pay a dividend, and it has preference shares, if they're cumulative preference shares and they don't pay a dividend this year, then they kind of have to catch up and pay all the accumulated dividends next year or the following years before they can ever pay any more common stock dividends. When they're non-cumulative and the company has a bad year and they can't meet their preference share obligations, then the following year they are able to start with a clean slate again. And finally, there may be other rights and characteristics with preference shares. There's a whole variety of rights and characteristics. Some preference shares give you voting rights. Some preference shares can be callable. Other ones can be convertible. Callable means that the company can call on the shares and buy them back at a predetermined price or rate. Convertible means the holders of the preference shares may be able to, actually, it can get even quirkier. Convertible just means they can sometimes, for predetermined reasons or predetermined conditions, be converted into ordinary shares or common stock. Alright, now it's time we've got a few examples here. This first example is preferred stock dividends, calculations, and journal entries. Alright, so here's our example. It's a bit similar, just with a few little twists, and I'll try to point out the differences. On the 1st of October, the board of Urban Green Limited declared dividends of $100,000. The dividend is payable on the 20th of October for stockholders on the 12th of October date of record. Note 1. There are 30,000 shares of common stock outstanding. Note 2. There are 5,000 shares of preferred stock outstanding with a right to a $10 dividend. Alright, so let's move into our Excel again. And here we are again. Key facts, same dates. This time there's 30,000 common shares outstanding and 5,000 preferred stock outstanding with a right to a 10% dividend. And this time, rather than declaring a per share dividend, they've just declared a pool of funds that need to be allocated. They've declared $100,000 worth of their earnings or retained earnings will be paid in a dividend. So this is actually a two-step process. First of all, we've got to calculate the allocations of the dividend pool. So first of all, preferred stockholders first. That's their right. They come first. Now we have 5,000 preferred stockholders entitles to $10 dividends. That means you've got to pay $50,000 to the preferred stockholders. Alright, after them, let's move on to the common stockholder dividends. Now there was a $100,000 pool, and then you have to minus the preferred stockholder dividends. So it's 100,000 minus 50,000, which leaves 50,000 for the common stockholders. And while this doesn't really matter in our journal entries, for your information, the dividend per common stock, we've got 50,000 with 30,000 common stock outstanding. So it would be 167 a share, rounded to the nearest cents. Okay, step 2, the journal entries. So it's almost the same, but this time we've broken up the preferred dividends and the common stock dividends. So again, we draw upon retained earnings and debit retained earnings on the 1st of October for the amount of $100,000. That was what was allocated in dividends. And this time we split it between two credits, 50,000 for preferred dividends payable, which is the 50,000 here, and the other 50,000 for the common dividends payable, which is what we calculated here. Again, no effect on the 12th of October. And then on the 20th of October, the payment date, we simply reverse out the liabilities, again keeping them in two debits, and we have a credit of cash at bank for $100,000. So you're picking up on the similarities there. Once you get the grasp, it's kind of it's easy to tweak little things for particular circumstances. We've got a few more examples, so I hope it's like flows on from here. Okay, let's go back to our slideshow. Okay, now we're up to example 3. Now example 3, let's just read it and see what happens, and then you'll see what the example is about. On the 1st of October, the board of Urban Green, so the same company, declared dividends of $40,000. So last time they declared dividends of $100,000. In this example, they're only $40,000. Dividend payable on the 20th of October, 30,000 shares of common stock outstanding, and 5,000 shares of preferred stock outstanding with a $10 cumulative dividend. This is where it's different. So it's not just a $10 right to a $10 dividend, it's a right to a $10 cumulative dividend. So let's get back to Excel, have a look. Okay, so here are the key facts. Now, everything's the same. Where it's different, I have bolded it and italicized it. So this time there's a $40,000 dividend, and this time that we've been more specific in that the preference shares have a cumulative dividend of $10. So step 1, we've got to calculate the allocations of the dividend pool. So first up, we have the preferred stockholder dividends again, same process, and it's same calculation, but this time $50,000 should be paid to the preference shareholders. But there's only a $40,000 dividend pool. Remember, they only declared $40,000. So they've only got $40,000 to pay, but they should be paying $50,000. Well, in this case, all $40,000 will be paid this year to the preference shareholders or the preferred stockholders, and the other 10% will accumulate. That is the cumulative dividend. So that $10,000 must be paid to the preference shareholders or the preferred stockholders and any other future or previous cumulative dividends before any common stockholders or ordinary shareholders can get their dividends. That's the cumulative part of a preference dividend. And secondly, this cumulative $10,000 isn't actually a liability. It's instead will be disclosed in the notes of the financial statements. So even though they have to pay back, I don't like to use that word. Even though they have $10,000 worth of cumulative dividends, they're actually not a debt or a liability. It's still contingent on the company earning enough profits to be able to pay the preference dividends in future. So because it's a contingent liability, it will be disclosed in the notes of the financial statements. And now, in accounting, the word disclosed or disclosure actually has a special meaning. When something is disclosed, it means it goes into the notes to the financial statements. In accounting, when something is recognized, then it goes in the financial statements, but when something is disclosed, it's not in the financial statements, but instead in the notes of the financial statements. Alright, so let's move on to common stockholder dividends. So we have the $40,000 minus the preferred stockholder dividends, And whoop-de-doo, the common stockholders get nothing this year. Alright, so let's go on to the journal entries. Again, this should look kind of familiar. So, retained earnings, debit 40,000, credit, preferred dividends payable, 40,000 on the declaration date. On the payment date, debit the preferred dividends payable 40,000, credit cash at bank 40,000. So this time there's no common stockholders or ordinary shareholders recorded in the journal entries because they don't get a dividend because it has to go to the preference stockholders first, and the common stockholder dividends won't be paid until this $10,000 cumulative dividend is later paid at a later date also. Okay, that's that example. Okay, example 4. This is the final one for preference stock dividends. So if you're getting done with this, like hang in with there a little bit longer. On the 1st of October, declared dividends 40,000. So rather than reading it out, that will do your head in. I'll say what's different. It's exactly the same as the last example, except this time it's a non-cumulative dividend. Non-cumulative, not cumulative. Do you remember what happens with non-cumulative dividends? I hope so. Let's have a look. Okay, here are the key facts, all the same, except for the bold, italicized, non-cumulative dividends. Calculate the allocations of dividend pool, all the same. Except this. The other $10,000 will be lost. It is a non-cumulative dividend. So, the common stockholders, even though they get nothing again this year, they might be able to be paid something next year or next period because this is non-cumulative. Journal entries are identical to last time. Okay, that was a quick example. Any questions, feel free to comment or get in touch, but I hope it's all crystal clear. And now we're moving on to the final section. These are stock dividends or share dividends. And sometimes companies pay dividends in shares, not cash. So instead of paying, $10 worth of cash to us, they might pay us $10 worth of their own company shares. Now, why do they do this? Well, there are 3 main reasons. That is because sometimes the company needs to conserve cash. So rather than paying like $10 million in dividends, it might just be easy to issue more shares and conserve that cash. There's also the added benefit. It gives the stockholders a choice. Now, if the stockholders want the cash, then just collect their new shares and sell the stock for the cash. There you go, they've got their cash dividend. But they also have the choice of being able to hold on to the shares that they've just been issued as a stock dividend and possibly reap greater benefits through the fortunes of the company than getting cash in hand. And finally, they sometimes do this as an alternative to a stock split. Now, stock dividends and stock splits have differences, but they also have a lot of similarities in outcomes. So for whatever reason the company might want to do a stock split, they may follow the path of issuing stock dividends or share dividends to get similar outcomes. But there is a slight little bit of difference in accounting, and that's what compared to the previous examples, and that's what you're going to see in our next example. So here's the final example. Stock dividends journal entries. Now the example is on the 1st of October, the board of Who Me Limited declared a dividend of $1 per share. The dividend is payable on the 20th of October for stockholders on the 12th of October date of record, and there are 75,000 shares of common stock outstanding. Now I hope this example looks very familiar to example 1. That first one we did just with your straightforward cash dividend, because when we look at the Excel and the journal entries, you'll see it's very similar. So here we go. Okay, so here we are in example 5. Now the key facts are identical to example 1. Instead of a cash dividend though, it's a stock dividend. And as you'll see, the journal entry is very, very, very similar. So the 1st of October, debit retained earnings 75,000, credit dividends payable 75,000. Remember from example 1, debit retained earnings $1 times 75,000 common stock outstanding, and credit the dividend liability $1 times 75,000 common stock outstanding. And on the payment date, this is the difference. On the payment date of 20th of October, you clear the liability for 75,000, as we always have, but rather than crediting cash, because we're not spending cash anymore, we credit common stock or share capital, because we're issuing $75,000 worth of our own shares to clear the dividends payable. So we now have common stock or share capital now has an extra $75,000 worth of capitalization. So it's identical to example 1. However, on the 20th of October, when you pay the dividend, you don't credit cash, you credit share capital or common stock for $75,000. And that was our final example. Alright, let's do a wrap up. What do we cover? A brief background on dividends, the 3 important dates of dividends, that is the declaration date, the record date, and the payment date. We had an example of just a straightforward common stock cash dividend. Then we moved on to preferred stocks, giving them a brief background. And then we had a few examples of preferred stock dividend calculations and journal entries. And then finally we had stock or share dividends, including a background and then a example that was very similar to the first example. Okay, that's it. I hope it helped. Best of success. There's your congratulatory fireworks. If you enjoyed the video, please subscribe to the channel. Click on the button that will soon appear. Watch another one of my tutorials now, or even just give me a like. Finally, feel free to comment below if anything needs clarification or if you just want to say hello. Thank you for your time today.